What's up everyone, it's Caddy with Money Investing. So in this video, wanted to break down two reports from Morgan Stanley and BlackRock, and both of them are quite interesting because we already know the markets right now is pricing in for rate cuts, and not just one or two rate cuts, 6 rate cuts in the next 1 year. And if every rate cut's going to be 25 basis points, that's about 150 basis points or 1.5% worth of rate cuts in the next year. That's a pretty substantial amount of quantitative easing expected from the Federal Reserve. So my question to you is Jerome Powell going to blink, or if he's going to stay the course in his fight to bringing inflation back down close to 2%? Let me know in the comment section down below, but I will be going over some other reports here. And the first thing is from Morgan Stanley, and they mentioned that every hiking cycle over the last 70 years ends in a recession or a financial crisis. Quote, "It's not going to be different this time." And no, it's not Mike Wilson from Morgan Stanley. It's actually a European strategist from Morgan Stanley in London called Graham Secker. And after the events of the last 2 weeks, that notion can be put to bed. And quote, "Every rate hiking cycle of the last 70 years has ended in a recession 80% of the times, and or a financial crisis in 1984 or 1994. A week ago, it was possible to argue that this observation was theoretical. Now we know that it's not, and it's going to be different. It's not going to be different this time," is what he also mentioned. Now, if you guys remember in 2022, we talked about how interest rates, as they go higher and higher and higher, there is going to be a point where it actually starts affecting the economy, right? We mentioned that there was going to be a breaking point. We talked about how we're getting towards the tail end of higher interest rates, and they are absolutely, without a doubt, going to affect things. Well, we're starting to see the early parts of that breakage in the economy with the bank failures and everything that happened with Silicon Valley Bank last week, with First Republic Bank, with Signature Bank, with Silvergate, with Credit Suisse. I mean, the list goes on and on. The tightening of this, financial conditions is going to be affecting almost all sectors, industry, and market participants, right? There's no way around it. But the question once again becomes whether the Federal Reserve is going to blink on this assumption that there's going to be more pain, and so we need to kind of give up on our fight towards inflation. We need to tap out and switch gears towards quantitative easing and start pausing and start cutting rates, because that's what the market seems to be pricing in. That's what the market is building its base assumption off of, right? I showed you guys the Excel spreadsheet, which pretty much does suggest six rate cuts in the next 1 year, and then a terminal rate of barely 5%, and that's had a huge dovish pivot, right? We flipped literally from 6% and down to 5%, and we're not even getting up to 5% on a terminal basis, and expecting about 150 basis points of cuts. Now, Secker did note that financial crises don't always lead to economic recessions, as evidenced in 1984, 1987, 1994, and 1998. However, at this stage, they said that we think the markets will run with the guilty until proven innocent approach, given the prospect of a material tightening in credit availability and lending standards from banks after recent events, and the deeply inverted yield curve going into the recent events as well. Now, BlackRock, on the other hand, on Thursday was warning investors, pretty much mentioned not to count on cracks in the banking sector to spur central bank to cut rates, as they used to do in episodes of financial stress, while pointing to different cases in the banking sector that have emerged in the US and Europe. BlackRock Investment Institute strategists said investors clearly are looking at bank vulnerabilities through a new high interest rate lens. And even so, betting on central banks to abandon planned rate hikes would be, quote, "misguided," the strategist wrote, and instead they see more rate hikes in the coming days as central banks, quote, "try to rein in persistent inflation," while regulators also offer support to the banking system. We are in a very, very interesting time. Like, since I've been covering markets and talking about it and investing personally, we have not quite seen such an interesting conflict between monetary and fiscal policy, between the banking sector and financial conditions. It is a very, very interesting time. And the reason I say that is because, on one hand, the Federal Reserve is actually lending money or funds, right, to banks that actually need it, right, in order to curb liquidity issues and to make sure that their reserve ratios are pretty well capitalized. So I talked about it in my other video. And then on another basis, you've got an inflation that's still much too high, and interest rates are obviously very, very aggressive. I mean, we've seen the most aggressive Federal Reserve since the 1980s, right? So BlackRock also goes on by saying, which oversees $10 trillion in assets, sees a fallout and a quote recession coming due to the damage caused by the fastest pace of rate hikes since 1980s, but also opportunities in short-term government bonds and emerging market equities as well. So my conscience is very clear. Like, I have a very clear understanding in terms of where we're potentially headed. And I strongly believe, and again, I could be wrong, but I strongly do believe that there is going to be Federal Reserve. Let's talk about the Federal Reserve first. I do believe that they are going to raise rates by 25 basis points. I think Jerome Powell is going to address the current economic situation with the banks, but I'm not so positive that he is going to suggest either a pause or a rate cut. I think there is going to be questions next week that the Fed Funds Futures is pricing in rate cuts. What do you think? Jerome Powell, I think, in my opinion, is not going to entertain that. And I think he's going to be all about inflation, just like Christine Lagarde was during the ECB. I think they're going to divert that more towards fiscal policy, making sure that people understand and know that the Treasury Department, FDIC, and their lending facility for the Federal Reserve are all there to support the banks if needed. But that is a completely separate issue, and they are still focused on making sure that inflation comes down. We have seen a very welcomed disinflationary reports in the last couple of months with CPI and PPI. So I think that's going to continue, and that's good. But I do still believe the Federal Reserve is not going to blink. Jerome Powell is still going to be on its way to raising rates by 25 basis points. If they don't, then that is a big strategy shift. That is a significant pivot from what they pretty much said 2 days before SVB fell out. So again, we got the SCP, we got the dot plot also coming out. So those are going to be some important things to look at. And if they continue to raise rates, and I'm not advocating for higher interest rates, I want to be very clear because I get some comments sometimes. I'm not advocating for higher interest rates. I'm just telling you what I believe Jerome Powell is going to do, not saying whether that's right or wrong, but just kind of reading between the lines. And I do think Jerome Powell is going to go for 25. He's not going to mention a pause or a rate cut. He's just going to keep that open-ended depending on what data comes in. So again, data dependent and depending on financial conditions. But when it goes to recession, I do also believe that in 2023, by the end or early 2024, there is going to be a time when unemployment is going to be much higher. And there is going to be more sort of situations like these where banks also start to deal with higher interest rates and more layoffs and more unemployment can lead to a potential economic recession in the US at the end of this year, early next year. So that's where my thoughts are. That's how I'm kind of aligning myself with the 2023 in terms of asset allocation. Still long term, still bullish on equities. US equities still kind of we'll be seeing that as an opportunity to pick up more shares at discounted values if prices do roll over. But we'll also be looking at real strategy in this volatility because we're moving a lot of sideways, and we'll also be building out some bond ladders, as well as increasing my cash exposure and maybe even consider some recession-proof industries such as staples and utilities in the future if and when we get down that road. So I hope you guys enjoyed this video. Again, a simple question I have for you is, do you think Jerome Powell is going to blink, or if he is going to continue to raise rates, and what do you think his tone is going to look like going into next week? So hope you all have a great weekend. I will see you all on the next video, but make sure that you drop a like, subscribe to the channel, and the link to our Discord and Patreon is going to be down below if you're interested in joining us. And as always, happy investing. I'll see you all in the next video.